Hi, how are you, trader? This is Mario from fxotherway, the channel for traders run by a trader. Have you ever got a sleepless night because of your open position? Did it happen to you? If you trade longer term than a few hours, how many times a day do you check your position whether it's going okay or it's a mess and needs to be closed? If it happens to you, it means that your position is too big. In this video, I will tell you what you should do to survive the cruelty of financial markets and what to do in order to make your trading account grow. If you will watch this video carefully, you will find here a good number of tips and methods to improve your trading system, especially the money management, which is extremely important. So let's start the rock and roll. What is your trading capital and how much money do you need to trade the Forex market, my friend? If you're on demo account and you've got, let's say, $200 for trading, it's okay, because as I told you in one of my previous videos, before you start trading, you must test your system on a demo account for at least 4-6 months to make sure that your system works. And well, you should do testing on micro or nano account in order to feel the thrill, to feel these emotions during trading when you're losing money, where the price jump up and down, and to get accustomed with winning and losing. That's the reason why you should get 200 quid or $200 on your account, just for demo purposes, for testing. But if your trading account is $200, it means that it is a play money and you're a dreamer. Trust me, you are a game player who hopes to get rich with no money. Or it means that you are undercapitalized and you waste your time on the market just trading. I don't want you to take it personal, but the smallest possible account size is very hard to grow. It will take ages to grow, and it doesn't worth a candle to spend countless hours for trading, analyzing, and whatsoever. It's better to sell veggies and fruits on the local market, because in this way you may easily double your business capital of $100 or $200 with one trading day selling vegetables. From the other hand, on financial markets, such a thing doesn't happen, because you've got against you all those bloody big sharks, all those investment funds, banks, hedge funds, and all trading individuals from all over the world. Trading is a job. I'm not going to discuss here is it easy or is it hard. Important is what reward would you expect from your job, your countless hours of analysis, preparation, and so on, opening position, closing position. So I'd like to ask you one thing. What is your hourly rate? Is it $2? Is it $5 at work when you work? Think about it, because even if you manage to double your trading account within a year, what is not impossible, but it's not easy neither, especially for traders with small experience. Anyway, it doesn't happen very often to double your account year by year. But even if you manage to do it within a year, what your hourly rate would be? Have you calculated it? Let's presume that you are not overtrading. You choose carefully your trades and you open 2 positions a week only on average, let's say, yeah, okay? So basically you did 104 trades within a year and you managed to double your trading account. And in the situation when you deposit $200 means that you have made roughly $2 per trade. Analysis, opening, checking, and closing every trade takes you, how much does it take you? An hour and a half. You say, yeah, I'm doing for pleasure. Bullshit. You're doing it for money. You want to earn money. You have to take it into account. You have to calculate it. So in this way, you make $2 every working hours. Does it worth or not? With the account of $1,000 or $1,000, your hourly rate will be $10 per hour. Are you happy with it or not? Just think about it. it's worth thinking, because if you are happy, prepare a grant and start trading with this money. With an account of 5K, $5,000 or pounds or whatever, or euro, your trade hourly rate will be roughly $50 or €50, £50. Consider it. So keep in mind, trading capital is just first important thing, but not the most important one. When you got your trading capital, even the big one, you don't need to deposit it, all this money, in one single account. Don't deposit it straight away when you got your capital. Please don't do it. Don't keep all eggs in one basket. Even the biggest brokers might go bankrupt. If you remember 15 January 2015, when the Swiss National Bank governor said they were not supported Swiss franc anymore at the level of, was 121 or 120 USD for 1 franc. Franc dropped 1800 pips just in a while. And the minimum of that movement was over 2700 pips lower, 2700 pips just after announcement. From the opening price of the day, it's unbelievable. Many brokers lost their business, but in the same time, their customers lost all their money. That's the reason why you shouldn't keep all the eggs in one single basket. Let me tell you now how my money management looks like, just want to show you, and how I protect my capital. First of all, I keep money with several brokers, with quite a few brokers. I got few brokerage accounts at different brokers. And I don't risk more than 3% of my trading capital in one single transaction. This is first and the most important protection in my opinion, and I highly recommend you to follow this rule, my friend. So 3% maximum of your trading capital in one position, no more. But I have some other precaution in my saving of my capital against those, unexpected market events like this one with the Swiss franc. What I usually do, I split my trading account between 3 up to 5 brokers. Actually, I've got 4 brokerage accounts at the moment. I closed the 5th one. So I keep only 6% of my trading capital at each of the brokers. I don't pull all the money over there. Most of the money are in my bank accounts, not at the brokerage accounts. So I've got something like between 18 and 30% of my trading capital spread to all those brokers, all right? It has got a lot of advantages. First of all, your broker, seeing you risk half of your account in one transaction, puts you, listen carefully now, puts you at the very beginning of your trading with this broker, puts you in the basket, let's call it loser's basket. The broker split customers at 2 different baskets, and loser's basket means that you trade against the broker, you don't trade against the market. In other words, your broker doesn't send your offer outside. He bets against you, knowing that you are risking half of your money in one go, because he thinks you put all your money in his account, yeah? That's the reason. At the beginning, it's very advantageous. It's big advantage at the very beginning. You are considered a high-risk customer. In broker's opinion or in broker's algorithm opinion, you are considered as a sheep going to be slaughtered quickly, which is good. Don't worry, it's nothing wrong with that. After several winning transactions, your broker will realize that you are very hard to slaughter and will move you to another basket and will send all the orders you place with him, with them will send outside. But first he loses some money against you, betting against you. So trading half of your deposit in one trade let you rip your broker off a little bit if it makes you happy. Now the second advantage, having 6% of your trading capital with one broker refrains you from overtrading. This is an enormous psychological factor which will keep you off the careless trading and, all this shit, triggering any trade because you got the feeling the market will go up or down. And, having the 6% of my money in my account, I know that I can make only 2 transactions on this account, but I never do that because in case when open transaction is a loser, which happens pretty often, I still have a possibility to open another transaction after that when a new signal or new opportunity appear. So keeping 6% of my trading capital on one account, I just risk only 2 losing transactions. From the other hand, if the account gets doubled, which happens pretty often, I withdraw half of the profit, not half of the capital, half of the profit, or 1/4, 25% of the account value at that particular broker, and what remains over there, I divide in 2 parts. So a part of the winning I send back to my bank account, and a part I leave over there with the broker and split the value in 2 parts again. So now the risk level, my risk level, is 4.5% of my trading capital, but it refers only on this one particular account because I risk 3% of my initial account and another 1.5% of the money I earned over it, in case of doubling. So that's how it works. If I doubled again, 25% goes back to my bank account and the rest on the trading account is split in 2 parts again. If losing, it's different story. If losing, obviously, as I told you, or I didn't tell you, when I lose, I usually keep the account frozen for a month or 2 months. So I highly recommend you guys this method. It will let you keep your money safe. No overtrading, no erratic decisions, no compulsive trading behavior, and much more control over your capital. That's what happens. As I mentioned, my position size never exceeds 3% of my trading capital, but it doesn't mean that I always open a position of that size. Usually, it's much smaller. It depends on the market conditions, but usually it's no more than 1% of my trading capital. In the past, I have read a book, I'm not sure it was about George Soros or Warren Buffett journal, whatever. It doesn't matter. But what I wanted to say is that I've learned one thing, one tip from the book. The guy said that if you are convinced, for example, to buy at a certain level and you are 100% sure that the market will go your way, open an opposite position. Strange, isn't it? So if you think 100% it goes up, open opposite position, sell. But the size of the position must be negligible, must be such a small or small enough to not damage your trading capital, just to give you this guts feeling whether you are right or not. So, very, very small account. Let's say your account is 10K, 10,000. So by this concept, you may lose 20 or 30 bucks on this opposite position, on this contrary position, which is less than 0.5% of your trading account. Trust me, this method is amazing. This contrarian approach makes miracles because if your forecast was right, after testing the market with a small-sized position, you will have more confidence opening a usual-sized position conform to your forecast. This method is very good also for pyramiding your position, means adding up when the trend goes your way every, 30 or 50 or 100 pips, you add up to your position another position and you grow and keep only break even all the positions till if you get your target. That's how it works. So, talking about the contrary approach, from the other hand, if you are wrong with your forecast and the market continues to go in the opposite direction to against forecast by you, or something major happens on the market and your mini position starts growing, then you may add up to the existing position and convert the testing small size position into the real winner. Watch my other videos and find out more about my trading techniques. So I'll see you next time, and thanks for watching. Bye bye.